Welcome back. Today we're diving into Amazon's latest earnings report for Q4. Amazon beat earnings expectations, but its weak guidance caused the stock to drop about 5% in extended trading. So, what's really going on? Is Amazon still a strong investment? Stay tuned as I analyze the numbers and break it all down for you. Don't forget to hit that like button and subscribe for more financial deep dives. Let's get going. Let's start with the key numbers from the report. Revenue came in at $187.8 billion, slightly ahead of the expected $187.3 billion. Earnings per share also came in really strong at $1.86, significantly beating Wall Street expectations of $1.49. This means that Amazon is performing well in terms of profit and revenue generation. However, the big concern for investors isn't about this past quarter, it's what's coming next. Amazon's Q1 revenue guidance is between 151 billion and 155.5 billion, while analysts were expecting 158.5 billion. This means Amazon is forecasting slower growth than anticipated, which worried investors. Adding to the pressure is Amazon's explanation. They blamed a $2.1 billion hit from unfavorable foreign exchange rates caused by a stronger US dollar. That might sound like a temporary issue, but what's alarming is that even without the currency effects, Amazon is projecting just 5 to 9% revenue growth, the slowest on record for the company. This is a major red flag for growth focused investors. Despite the lower revenue outlook, Amazon has actually doubled its net income year over year. This is a result of aggressive cost cutting measures implemented by CEO Andy Jassy since late 2022. These efficiency improvements include mass layoffs, streamlining logistics operations, and optimizing cloud infrastructure costs, all of which have boosted Amazon's profitability. One key metric to highlight is Amazon's operating margin, which climbed to 11.3%, a huge improvement over last year. This means that even though revenue growth is slowing, Amazon is keeping more of its earnings, making the company more resilient to economic downturns. Additionally, Amazon's free cash flow turned positive for the first time in years, reaching $36.8 billion. This is a crucial milestone because it shows Amazon is now self sustaining rather than relying on debt or equity issuance to fund operations. This is great news for long term investors who have been waiting for Amazon to shift from its historically high reinvestment model toward a more sustainable, profitability driven approach. One of Amazon's biggest businesses, Amazon Web Services, generated 28.8 billion in revenue, which was exactly in line with estimates. That might sound like good news, but the bigger story is AWS's growth rate, just 19% year over year, which is the slowest growth AWS has ever reported. Now let's compare this to Amazon's biggest competitors in cloud computing. Microsoft's Azure grew 31% and Google Cloud expanded by 30%. These numbers indicate that AWS is not growing as fast as its rivals, raising concerns about whether it can maintain its market dominance in the long run. Amazon has long been the cloud leader, but competition is intensifying. Microsoft's deep integration of AI services within Azure, thanks to its OpenAI partnership, is attracting major enterprise customers. Google Cloud, on the other hand, is rapidly gaining ground with its AI driven analytics and security solutions. The key question: can AWS fend off this competition? While AWS remains highly profitable, Amazon will need to differentiate its services and drive innovation in AI to stay ahead. To stay competitive in cloud and AI, Amazon is massively increasing its spending. Capital expenditures skyrocketed to $27.8 billion, almost double the $14.6 billion spent in the same quarter last year. A huge portion of this spending is being funneled into AWS infrastructure, including expanding data centers, developing proprietary AI chips, and acquiring top AI talent. Specifically, Amazon is investing in its Trainium and Inferentia chips, designed to compete with NVIDIA's GPUs in AI training and inference workloads. The in house chips could help Amazon cut costs and increase efficiency for its AI powered cloud services. Amazon also unveiled Nova, its latest AI model designed to power Alexa and AWS enterprise solutions. However, AI models require massive computational power, which is why Amazon is aggressively scaling up its high performance computing infrastructure. With a planned $100 billion in capex this year, Amazon is making a bold bet on AI and cloud expansion. But the biggest question remains: will these investments translate into meaningful long term revenue growth, or is Amazon overspending without clear returns? Amazon, Microsoft, and Google have been pouring billions into AI development. But here's the shocking news: a Chinese startup called DeepSeek just developed an AI model called R1 for less than $6 million dollars in just 2 months. This revelation has sent shockwaves through the AI industry. If a small startup can create a powerful AI model with a fraction of the budget of these tech giants, what does this mean for the future of AI investments? For Amazon, Microsoft, and Google, this raises serious concerns. Investors are now questioning whether these companies truly need to spend billions on AI or if they're simply overestimating the resources required to stay competitive. If smaller firms can continue to rapidly develop AI with lean budgets, it could force Amazon and its rivals to rethink their strategies. This could mean either reducing AI investment, focusing more on software optimization, or shifting toward acquiring smaller, more efficient AI firms rather than building everything in house. For now, the race is still on. Amazon and its cloud competitors need to prove that their AI investments are delivering real value. Otherwise, we could see a major shift in how AI is developed and funded in the tech industry. One bright spot in Amazon's business: advertising. Revenue from ads grew 18% year over year to $17.3 billion, showing that brands are spending heavily to gain visibility on Amazon's platform. Amazon has become the third largest digital advertising platform in the US behind Google and Meta. This segment is highly profitable and growing fast, helping Amazon offset some of its slower growth elsewhere. So, what should we take away from all of this? Amazon is more profitable than ever, thanks to cost cutting and better margins. AWS is growing, but not as fast as its competitors, which raises concerns about its long term dominance. AI investments are massive, but questions remain about whether they're truly necessary. Advertising is a major bright spot, showing strong growth and profitability. The big question: is Amazon still a great investment? If you believe in their AI strategy and cloud leadership, this could be a long term buy. But if you're worried about slowing growth and tough competition, caution might be warranted. And that wraps up my dive into Amazon's Q4 earnings. If you found this analysis helpful, don't forget to hit that like button and subscribe for more in depth financial breakdowns and news about the stock market and economics. Thank you.